about term, what we typically refer to as term in the private money business is the length of the loan. So most private money loans will either be 6 months, 1 year, 2 years, 5 years, sometimes 10 years. And then if we get into the consumer purpose side, they need to be fully amortized. And what fully amortized means is that the loan has to have payments that will, over time, eventually pay off the loan to zero. So in our world, that means a 30-year loan. That's basically loan terms that you'd be looking at on a private money loan. Now I'll let Karen talk a little bit about the institutional side loan terms.
For institutional loans, the most popular loan term is a 30-year fixed. That's a traditional 30-year fixed mortgage. The next most common one you'll see is these hybrid loan programs. This is the 3-year, the 5-year, the 7-year fixed arms, and even 10-year fixed arms. So they're fixed for 3, 5, 7, or 10 years, and then they adjust. An adjustable rate mortgage is a mortgage where the rate adjusts one time per year. That's why it's called an adjustable. So it's fixed for 3, 5, 7, or 10 years, and then thereafter the rate will adjust one time per year for the remaining term of the loan.
So the next question is, which one is best for the consumer? Well, that depends on a lot of different factors, such as how long they need the loan for. And why does that factor in? The longer the term that is offered, the higher the private investor is going to want on their yield, meaning the rate that they charge. So for example, a 1-year term, an investor will be much more apt to make a lower interest rate loan than if he's committing to 5 years. What also matters is the direction of interest rates. So if you're a private investor and you're lending out money and you see that the going market rate today is maybe, let's call it 8% for a 2-year loan, and he sees that interest rates are going up, he's going to start thinking, hey, in 3 or 4 years, the rates are going to be up at this level, and therefore, I think I need to protect myself and say I need a higher yield. So that same person that might make a 1-year loan at 8% might say if they need 5 years, I'm going to have to make that loan at 9%. We have a lender that will actually tailor whatever term fixed you want to go with. So some people say, you know what, on my current loan, I only have 14 years left. Can you write a 14-year mortgage? The answer is yes. We can write a 14-year fully amortized mortgage. You're not going to like the payments on it, but we can do it. There are so many creative ways, and over the last 3 decades, we've discovered those methods. That's where we think we're a real value plus to our customers, is we have that expertise to really know what can and can't be done.
Right, and who knows, we may have already overcome their problem in the past and already have a solution for them that they don't know about, or they haven't come across a lender who knows about that solution. So you never know, you just need to ask.
Yeah, since we are the decision makers and it's our money, it makes us a lot more flexible with what we can and can't do.